So big changes are coming to Indian banking in 2026. A whole new set of rules designed to keep our money safe. But what does that actually mean? And, what's in it for you and me? Let's dive in and unpack it. Okay, to really get why these new rules are such a big deal, we need to travel back in time a bit, to March 13th, 2026. The stock market, well, it absolutely cratered. The Sensex just plummeted by almost 1,500 points. That's not just a bad day. That's a signal that something is seriously wrong. So what on earth was going on? And really, it was like the perfect storm. You had escalating conflicts out in West Asia, which put a major squeeze on global oil supplies. And when oil gets expensive, what happens? Yep, inflation fears go through the roof. On top of all that, the rupee was tanking, hitting a record low against the US dollar. You could just feel the tension in the air. The entire economy was walking a tightrope. So that really begs the question, right? When things are this volatile, when something happening halfway across the world can shake our markets to the core, how do you protect things? How do we build, a stronger shield around our financial system and, frankly, around our own money? Well, this is exactly when the cavalry arrived. With everything feeling so precarious, India's top financial watchdogs, you know them, the Reserve Bank of India, RBI, and the Securities and Exchange Board of India, SEBI, they decided it was time to step in. They came forward with a brand new game plan, all designed to bring back some much-needed stability. And this quote from an Angel One report just nails it. It says Indian banks are set to operate in a more regulated environment. And the key word there is pivotal. This wasn't just some minor adjustment. We're talking about a massive, fundamental shift. The whole system was moving towards being more regulated and hopefully way more secure. So what does that actually mean in practice? Let's get into the nitty-gritty. All right, let's start with the stuff that's going to impact you like tomorrow. I'm talking about your everyday digital banking. This is where you'll really see these new rules in action. So, first things first, the RBI is clamping down hard on digital services. Think about your banking app, internet banking, even those little SMS alerts. From now on, any bank offering these has to play by a much, much stricter rulebook. You know that old tech mindset of move fast and break things? Yeah, that's over, at least in banking. And this put a very clear timeline on this. Mark your calendars, January 1st, 2026. From that day on, banks need to get a green light from the RBI just to offer digital services, period. Then, fast forward to April 1st. That's when a whole new, super secure system for approving digital payments becomes mandatory. No exceptions. So, what's the bottom line for you? It's pretty simple, actually. More control and way more security. You're going to have to give your okay for services, you'll get instant alerts for everything, and your payments are going to be locked down with things like two-factor authentication. Basically, your digital bank account is getting a Fort Knox level security upgrade. Okay, so security is a huge part of this, but it's not the whole story. The regulators also wanted to make banking more accessible for everyone. And that brings us to the next big change, which is a massive win for anyone with a basic savings bank deposit account, what they call a BSBD account. And get this, starting April 1st, 2026, a whole bunch of essential banking services are going to be completely free for these accounts. We're talking full digital and internet banking access, free ATM cards and renewals, free checkbooks, the whole shebang. It's a game changer, really, aimed at making sure everyone in India can access basic banking without getting nickel and dimed. All right, so that's the stuff that affects our daily lives. But the regulators didn't stop there. They also went after the big picture stuff, strengthening the very foundations of the financial market to stop those kinds of scary market shocks we talked about from happening again. And a huge piece of that puzzle, it's all about how banks lend money to stockbrokers. The RBI's main goal here was pretty clear. They wanted to pull some of the risky borrowed cash out of the system. You know, the stuff they call leverage, which can act like rocket fuel for the market on the way up, but also on the way down. And the new magic number is 100%. That's right. From now on, if a bank gives a loan to a broker, it has to be 100% backed by collateral. This is absolutely massive. It basically kills the whole idea of giving out high-risk, unsecured loans to brokers. And they got even stricter when it comes to something called proprietary trading. That's just a fancy term for when brokers are playing the market with their own money. If they want a bank to back those trades, now at least half, 50% of their collateral has to be cold, hard cash. This makes it a lot more expensive for them to make those huge, risky bets because they have more of their own skin in the game. And there's more. If a broker tries to use stocks as collateral, the bank has to give it a haircut of at least 40%. Let me break that down. It just means if you have shares worth, say, 100 rupees, the bank will only value them at 60 rupees for the loan, so you can't borrow as much. It's another clever way to turn down the volume on that risky leverage. So you have the RBI tightening the screws on one side. Meanwhile, the other big regulator, SEBI, was also making moves. But their approach was a bit different. They focused on something called alternative investment funds, or AIFs. And instead of adding more rules, they actually decided to streamline the old ones. And you can see the difference right here. The before picture was a nightmare. These funds had to file super detailed, repetitive reports every single quarter. Just a massive headache of paperwork. The after picture, the new 2026 framework, is so much smarter. One big, detailed report once a year, and then just a simple, quick update each quarter. It cuts out all the red tape, makes it easier to do business, but you still get the important information. Okay, let's take a breath. We've talked about digital banking, basic savings accounts, new rules for brokers, and even investment funds. That's a lot. So let's tie it all together. What does all of this actually mean for you, the investor, and for the economy as a whole? When you boil it all down, it comes down to a few key things for you. 1, there's less risky money sloshing around the market. 2, the brokerage you use is probably on much more solid financial ground. 3, the chance of one of those domino effect crises during a market dip is a lot lower. It all adds up to a system that's just more stable and, hopefully, more trustworthy for all of us. And that leaves us with one big final question, doesn't it? The regulators have definitely built some higher, stronger walls around our financial system. But in a world that's always changing, always throwing curveballs, can you ever really be 100% shock-proof? It's something to think about. So there you have it. That's our quick look at the huge new rules that are going to be shaping India's financial landscape. Hopefully, it gives you a clearer picture of what's going on behind the scenes. Hey, if you got something out of this explainer, do us a huge favor and hit that like button. And of course, share it with anyone you think would be interested. And make sure you're subscribed so you don't miss our next deep dive. But now, I really want to hear from you. What do you think? Are these new rules the answer? Are they enough to make our economy truly shock-proof? Drop your thoughts down in the comments section below. I'm really curious to see what you think. Thanks for joining me.